How's everyone doing? Welcome back to another episode of The Banker Next Door. I'm your host, Dr. Joe Berquist. So here we go again. I've got another episode on private credit, yet another warning on the private credit market. I've been talking about this all year long. Back in June, I did an episode where I covered a report from the Boston Federal Reserve, which basically was warning banks about the potential systemic risk about being involved in the private credit market, about how the private credit market was just mushrooming, ballooning, just completely out of control. So now we've got a new report coming out from Fitch Ratings, basically warning of basically the same thing. A big, if they shock to the system of private credit or to the private credit market, could create a giant systemic risk for a whole bunch of people. So let's go in here. There's actually two articles I'm going to show you here, both from Fitch Ratings. So the first one here, and this just came out on Monday, September 29th, systemic shock could expose private credit's broad reach and growing risk. But before we get to that, I want to share you an article here from June, also from Fitch Ratings, called Private Credit's Growing Complexity Untested Through Market Cycles. Now, this was around the same time that the Boston Federal Reserve came out with the report that I also reported on. That episode was titled Fed Warns Banks on Private Credit, Ties Create Systemic Risk. And I will put a link in the end card at the end of this episode. There'll be a link to that episode if you want to go watch that episode. But let's get into this here for a second. So private credit's growing complexity untested through market cycles. So private credit markets remain resilient despite recent challenges stemming from tariff-driven market volatility, slowing economic growth, and a higher policy rate trajectory than initially anticipated at the beginning of the year, says Fitch Ratings. Much PC private credit lending is focused on non-cyclical sectors like business services, technology, and healthcare, meaning first-order impacts from tariffs appear to be limited. And again, I'm just going to do a sidebar here. This is again all this nonsense about tariffs and tariffs are going to destroy the world or whatever. Obviously, a few months after this, we've seen that this is just not the case and not true. But anyway, okay, but let's continue here. So. However, over time, second-order effects of the trade war and the deteriorating economy amid the delay in M&A activity, obviously M&A activity has picked back up, could yet feed through to PC. The ultimate effects will depend on the severity and duration of an economic slowdown and the level of concentration and contagion risks across companies and sectors. No, I think the bigger issue is the fact that the Federal Reserve has created this beast since going back to 2017, 2018, when they had zero interest rate policy and quantitative easing and basically forced people and companies, particularly hedge funds, private equity, to what was called reach for yield. And that got them into the lending business and basically buying loans. And what has accelerated this process is with the Fed, with their interest rate tightening cycle, where they dramatically increase interest rates, they caused a whole lot of problems for big banks in their loan portfolios. Not to mention their bond portfolios. And now banks have been dumping, banks were doing a lot of extend and pretend, but now they've basically been dumping a lot of their bad loans into the private credit market. So I think the bigger issue is not with tariffs and a slowing economy and all this other nonsense. I think the bigger issue is that you have a ton of garbage loans sitting in this private credit market that is just piling up by the day. But again, I digress. So in Fitch's private credit Q&A report, we address key questions from global investors, including: does private credit growth and size pose systemic risks? Do banks face financial stability risks from private credit exposure? How does the change in rate outlook affect middle market borrowers? What are key trends to watch for business development companies? What second order effects do BDCs face from tariffs? How do open-ended retail strategies introduce risk opportunities? What are key considerations of alternative investment manager and insurance interconnectedness? Well, the private credit industry is growing in size and complexity, fueled by evolving asset classes and structures, and is expected to reach $2.7 trillion by 2029 from $1.6 trillion at fiscal year end 24. according to Preqin. The PC markets remain resilient, offering customized investment solutions and durable capital that supports corporate credit growth. However, outsized growth and interconnectedness from evolving products and asset classes require close monitoring, with many untested through market cycles. Now, here you have this nice little chart here they provided us with, which has basically key rating driver, risks, and mitigants. So we have asset quality, which is a key rating driver. So what are the key rating drivers? We have asset quality, earnings and profitability, funding, liquidity and coverage, capitalization and leverage, and we have systemic implications. So for asset quality, what are the risks? Well, we get outsized growth in an untested period, lack of through the cycle track record for many PC lenders, deterioration in lending terms, borrower credit risk rising, higher loan concentrations within lender portfolios or funds. Yes, basically everything I've just told you about. The mitigants. Lenders primarily focus on secured lending with increasing equity cushions in the transactions. They hope. Lenders typically exhibit good alignment of interests. They hope. Let's see here. Earnings and profitability. What are the risks? Rising rates represent higher debt service costs for borrowers. Yes, that's why the banks got rid of them. What are the mitigants? Rising rates increase lenders' net interest income, absent asset quality deterioration. Yes, that's the big caveat there, absent asset quality deterioration, which you're going to have. Funding, liquidity, and coverage. What's the risks? Borrowers face looming maturity walls in 2026. Yes, another reason why the banks dump them. Lenders, what are the mitigants? Lenders exposed to limited liquidity, transformation risk, whatever. Capitalization and leverage. What is the risk? Borrower level leverage continues to climb. Yes, what are the mitigants? Lenders exhibit solid asset coverage cushions and low leverage. Maybe, systemic implications. What are the risks? PC lending exhibits relatively less transparency and regulation versus bank lending. Yes. Banks are often lenders to NBFIs, creating second-order exposure to PC markets. Yes, yes, and yes. And then what are the mitigants or supposed mitigants? Small market potentially insulates wider system. No, not when it gets up to $2.7 trillion. PC exposures for large U.S. banks average less than 30% of equity. Yeah, that's not going to save everything when the Fed comes back, when they come back to the Fed looking for a bailout. So, okay, now let's get into this one. This is from Monday. So systemic shock could expose private credit's broad reach growing risk. So a shock to the financial system that impacts the private credit sector could reveal the extent that it has moved from a niche product for sophisticated investors to an increasingly relevant component of the global capital markets. Fitch Ratings says private credit's pervasiveness could amplify a systemic shock and impact a wide range of investors and lenders, including pension and sovereign wealth funds, banks, insurance companies, foundations and endowments, high net worth individuals, and increasingly retail investors, not to mention all the hedge funds and private equity funds at the very heart of private credit at the private credit market. This could result in far-reaching consequences for capital formation, credit availability, consumer confidence, spending, social safety nets, national development, depositor stability, and insurance availability. So what they're actually saying there, and what they're setting the stage for, is that they know this thing's going to blow up, and when it blows up, okay, and all these guys come back, they're prepping you for the bailout. Okay, that's what this is. That's what all this saying. They're prepping you for the bailout. I want you to remember that. So in 6 months, in a year, whenever this puppy goes, I want you all to remember what I said here, and I want you to come back to. We're going to come back to this episode, and I'm going to say, there you go, and I'm going to look like Nostradamus. Maybe not that good. But anyway, Fitch does not currently view the risks associated with private credit as systemic. Oh, of course they don't. Despite the sector exhibiting various bubble-like attributes. Oh, you bet it is. Including rapid growth and financial innovation, spread compression, heightened competition, growing retail participation, and rising borrower leverage. This is because private credit is still a relatively small portion of the overall financial system and is typically facilitated through funds with committed capital, limited redemption risk, and moderate fund level leverage. That said, in the event of a broader economic stress, private credit could be a meaningful transmission channel given its growth and increasing interconnectedness across various parts of the financial system. The private credit industry is growing in size and complexity. As of the fiscal year end 2024, it was comparable in scale to the U.S. leveraged loan and high yield bond markets, each at 1.6 trillion, and is expected to reach 2.7 trillion by 2029, according to Preqin. Now, obviously, that size market, they're now a player. They're now at that size. They're now a player. If they're the same size as the leveraged loan and the high yield bond markets, yeah, they're a player, so to speak. In the event of a systemic shock, a sharp widening and risk indicators such as interbank spreads and interest rate shock or rising margin calls, the private credit sector could be exposed to losses and or elevated redemptions. You bet you know what they are. Given the possible transmission effects and downside risks, the private sector warrants continued close monitoring and would benefit from increased oversight and transparency. Yeah, that's their CYA, ladies and gentlemen. So look, in the second paragraph, they prep you for what the eventual bailout that's going to come. And in the last paragraph, they provide their CYA. So given the possible transmission effects and downside risks, the private sector warrants continued close monitoring and would benefit from increased oversight and transparency. So that's how Fitch Ratings. Remember, Fitch is one of the big three rating firms. What happened during the financial crisis? They got egg all over their face, and they were never held accountable for what they did during the financial crisis. They were never held accountable. These guys were basically getting paid to issue ratings. That practice may still be going on today. I don't know. But they were getting in 07, 08, they were getting paid to issue ratings. So say, hey, whatever you wanted, baby. You want a AAA rating? Just cut the check, leave the envelope, you get whatever rating you want. I mean, it's ridiculous. And now it's like, here we go again, same nonsense. So let's take a look. They got another chart here for us. Let's take a look at this very quickly. So private credit, not systemic, but is a growing risk transmission channel. So what do we have here? So we have systemic implications, capitalization and leverage, funding, liquidity and coverage, asset quality, earnings and profitability. So let's take a look at systemic implications. What are the risks? Relatively less transparency and regulation versus bank lending. Banks are often lenders to private credit, creating second order exposure. Yes, absolutely. What are the mitigants or supposed mitigants? Large banks have modest, albeit growing, direct exposures. And private credit exposures for large U.S. banks average less than 25% of equity. That's not comforting. It's not comforting. Capitalization and leverage. Borrower level leverage continues to climb amid elevated competition. That's the risk. What's the mitigant? Lenders typically exhibit solid asset coverage cushions and low leverage. Yeah, so we're told. Funding, liquidity, and coverage. What's the risks? Borrowers face looming maturity walls in 2026. What's the supposed mitigant? Lenders' exposure to limited liquidity transformation risk. Yeah, I'm not buying that. Asset quality. What are the risks? Outsized growth in an untested period. Lack of through-the-cycle track record for many lenders. Deterioration in lending terms. Borrower credit risk rising. Higher loan concentrations within lender portfolios and funds. What are the supposed mitigants? Lenders primarily focused on secured lending with increased equity cushions in transactions. Lenders typically exhibit good alignment of interests. And then what's the last one? Earnings and profitability. What's the risks? Elevated rates represent higher debt service costs for borrowers. What are the supposed mitigants? Modest interest rate cuts underway in many advanced economies. Elevated rates increase lenders' net interest income, absent asset quality deterioration. So again, I think these mitigants are highly flimsy because a lot of the loans that got pumped into this private credit market were flimsy at best to begin with. All the risks here are spot on. All the risks are absolutely spot on. Lack of through the cycle track record, higher loan concentrations, deterioration in lending terms, borrower credit risk, elevated rates, borrowers face looming maturity wall. Banks are often lenders to private credit, creating second order exposure, relatively less transparency and regulation versus bank lending. Absolutely spot on. I think all the risks, they nailed all the risks. And I think a lot of the mitigants are very flimsy, very, very flimsy. So, but again, I wanted to bring this to everybody because I have been talking about and warning about the private credit market all year long. And now in June, we get a warning from the Federal Reserve Bank of Boston. And now we've got, Fitch here warning. Don't forget, Jamie Dimon over at JP Morgan, he warned about the potential perils of the credit market right before he said JP Morgan's going to get into the private credit market. Gotta love it, man. Gotta love it. I guess despite the risk, he still needed a piece of the action, right? I guess he still needed to get in there. So anyway, all right. Well, I'm going to wrap up by saying if you like this episode, please make sure to like, share, and subscribe, as that really helps the channel. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please be sure to leave your comments down below. If you have any thoughts on private credit, I would definitely like to hear about them. And as always, make sure to check out some of the other content on the channel. I just did a 4-part series earlier this week that ran parts 1, 2, 3, and 4 of Is AI Profitable? If you haven't checked that out, please go check that out. I think you might find it interesting. And then, as always, the BND Strategy Room live stream live on YouTube Saturday nights at 8 o'clock. Please go on and check that out. But until then, have a great time out there. I thank you for listening, and I will see everyone again real soon.